Welcome to another episode of the Eitel Insights podcast. My name is Dane Eitel, and I am the founder and lead analyst for Eitel Insights. Today we're going to be going over the Greater Vancouver Detached market update, and as you can see on the title of the podcast, this market is very much in the eye of the storm. Eye of the storm is eerily calm with chaos on either side. Now, before we do get into today's content, of course, we ask you to give us a thumbs up on today's podcast if you do appreciate the content that we are providing here for you. And then obviously, please feel free to share this on your social media platforms. Our subscribership is growing. It would be nice to eclipse 500 or so here in the next few podcasts. That would be great for us. And of course, you know, the content that we do provide seems to add a lot of actionable intelligence for our clients. And of course, we want our client membership to grow and the knowledge to spread here far and wide, so that during this challenging time of the real estate market, you can have some guidance. One other thing that is new for Eitel Insights, on our website, we do have a free subscription a newsletter that we are sending out now. So if you just visit Eitel Insights, peruse the website for a couple of seconds, you should see a prompt or a pop-up that you just enter your email address and you'll be added to the newsletter subscription base. It's a nice way, it's an easy way entry into Eitel Insights client membership. As we've said in the past, membership comes with privilege, and we will be releasing, of course, our monthly updates to you, so you don't have to go and search them on our website. Also, we'll release some basically exclusive content that you'll get first sent to your email, and then we'll put it up on the public website later. So it's a nice, easy entry to become an Eitel Insights member. That being said, let's start with the chart here. As everybody knows, we usually start out with our price charts, and that's why we're going to start today. So the August sale price came in at 1.38 million. So that is up from the July data sale price of 1.60 million. Our ardent followers know we didn't get a July detached market update out, so we'll be giving you both data points here today. Basically, where the data price, the average sale price showed up was, again, right in that middle threshold, and it is temporarily breaking that yellow downtrend that we had identified on there. Of course, that's why it was in yellow. We needed a few more data points to confirm that. We'll see what happens here in the upcoming months. Well, it will act fairly volatilely and bounce back below that yellow threshold and possibly test that 10-year uptrend. We'll see how the data rolls out. What's very technically interesting to us is this data point at 1.640 is the 20th data point inside of a $60,000 band going back to 2016. So basically the last 58 data points, roughly 30% of them fell within 1.580 and 1.640. So what that indicates to us is that this middle threshold is completely worn out. Like it's had multiple tests. It's that, the straw on the camel's back. One of these data points will just be too much. And as you see on the chart, that upper threshold has been pretty much filled out, going back to 2016 to basically the middle portion of 2018. That thing's well filled out. Where isn't absolutely filled out is the lower third of the market. We did test it originally at 1.480 and 1.5 again in that middle threshold, or that middle portion of 2019. February was 1.48, and prices hovered around there for the next 2 quarters or so. That's ultimately where we believe this market's going. It will actually go below there. We believe the prices will test 1.40 million in 2021. Now, people have said, well, why isn't it dropping? Well, we'll get into the inventory numbers, but inventory numbers are completely low. My question is, why aren't prices going higher if there actually is true demand in this market with such paltry inventory numbers? So we will get into the inventory later in the podcast, but I'll just give you a little tidbit here. So basically, the inventory of August is the highest over the past 10 months, so we still are growing. However, it's lower than it's 2,000 active properties lower than the August of 2018, the summer months of 2018, 2,000 active properties lower. So there's barely any inventory. Prices should be increasing given that supply-demand scenario if there is that demand. We've been stating there isn't that demand, but there is a growing need to sell. And we'll give you a few live examples here in a couple of minutes of a need to sell base that is rapidly growing. And there's definitely no investment going on in this detached market. I mean, it's very rare, if at all, that there is just a straight investment bet, depending on which market you are. Of course, inside of the 20 markets, every market does act individually. And that's what the Eitel Insights reports are all about. Those are available on our website. But with inventory so low and interest rates so low, why isn't this market running away? Well, first of all, they just basically publicly stated that the 2% inflation rate, which is directly correlated to the interest rate, is moving off the 2% and likely going up to a 3%. So there's no real panic or a rush to think that the mortgage rates are going to start to rapidly increase here going forward. So really, you got time on your side. And as you know, if you got time on your side and there's more desperate sellers arriving onto the market, prices will actually start to decrease, will continue to decrease, even though they are down 200,000 from their peak during May of 2017. So that's kind of that misnomer where the market is really hot. It's not. It should be a lot hotter than it is given the dynamics. Now for a couple of examples. So 2018 was still a great market and you could get multiple offers. We said, no, it wasn't. It was falling off. 2019 proved us up correct. Now we're in a similar boat again. They're saying, wow, 2020, 2021 is going to be amazing. Well, no, it's not going to be. It's going to actually be quite a bit worse than where we are today. So for an example, there was a property that listed at 1.658 in 2018. Couldn't sell, couldn't get an accepted offer, came off the market because, of course, 2019 was going to be better, right? Says his realtor. That didn't end up happening. They took the property off for 2 years. In 2020, for whatever reason, they kind of needed to sell justifiably by their sales price or list price. It changed from 1.658 down to 1.378. So that's basically $280,000 off of the list price, and it ultimately sold at 1.285. That's $470,000 less than what he was hoping to ascertain in 2018. Doesn't sound like the market's going up to me. Now I'll give you another example of the higher end market, and there's a lot of high end properties or higher valued properties that are selling at significantly discounted prices, like millions of dollars off the list price, but they're getting out of the market. Why are they getting out? Well, the coronavirus is a real thing. A lot of businesses are in trouble, and if you sell your personal asset or your secondary asset, it can keep your business afloat for a while. And that's why we say this economic impact. This is the eye of the storm. It's going to hit on the other side of this, unquestionably, no doubt about it. So we'll give you another example. In 2017, during an actual hot market, when the market was peaking, they tried to sell this property at 5.288. Couldn't get it, was pie in the sky, they all agreed, and it was worth a shot. Seemingly in 2019, things started to change and they actually needed to sell this property or extremely wanted to sell this property. 2019, it started listed at 4.788, went down to 4.388, went down to 4.25 or 250, and in 2020 relisted at 4.1. It ultimately sold at 3.8 million. That's basically 1.488 off of what they had originally anticipated in 2017. So again, the market reality is these are lower prices than what was previously experienced. That's exactly what Eitel Insights has guided you. Market's going lower. What's going to happen next year is the market's going to go lower again. So as a buyer, you can anticipate getting a better property with more selection. And as a seller, it's going to be a challenging time. Okay. Now here's a way to get a multiple offer, and you hear of the odd multiple offer, but not as many as a couple of months ago, and it's dwindling as we go. So a property was listed in June of 2020 at 1.367 million, decreased down to 1.299 million. Couldn't get a sniff, couldn't get an offer, couldn't get a bid. Property was relisted at $999,000. It ultimately sold at 1.262. So that's how you get a multiple offer, is to wickedly undervalue your property and hope that the market does value it enough so that it's near what you were expecting in the first place. That's a technique that's been around and will come back around into vogue here as we go forward, is to try to lower the price, the list price, and then expect multiple offers. What's already occurring is you price it low, but maybe not low enough. And you actually have to increase your price within a few weeks or a month because the seller wasn't going to sell at that price. So they actually have to put it at what they wanted. And that's kind of an embarrassing thing for the market or for that seller. But that's quite prevalent and will continue to go on. So again, these at these prices, you don't see too many sellers being like, you know what, let's just put it on the market and see what happens. Like, these are sellers that are saying, I got to get out of the market, I want to get out of the market, or I'm moving. Like there are, if you got a new job or you're moving to Alberta, or you're just getting out of the city. These aren't decisions that you're making because you're going to win the lottery and a windfall on a sales price. These are need-based sales, and that's what we've explained about 6 months ago, maybe even a year ago, would be occurring to this market. Now, one thing that if you do subscribe to the newsletter, you'll be getting is the mortgage in arrears. We have a beautiful chart that we've already released it to the Michael Campbell Insider's Edge folks, but we'll be releasing it to our own people here in short order. Those mortgage in arrears, they are still technically fairly low, but man, are they going to bounce up. And according to the chart and the article that we release, mortgage in arrears or delinquent mortgages, they're not a sign that a market's going to be turning negative. A negative market creates mortgage in arrears. So if property values continue to increase from the 2017 highs, you wouldn't necessarily be in arrears because you got $200,000 of equity, extra equity. But this is the reverse. You have $2,000 less equity than you had at the time of purchase compared to 2017. So yeah, there's not any extra money you can borrow out of the house to help pay your mortgage if you don't have the money. And CERB's been helping you out, CERB, and the mortgage deferral program. Those are all coming to an end. So I don't think that EI is going to pay too many people's mortgage. There's going to be continued need-based sellers coming to the market, and they're going to pray that they get those sales. So it's going to be an interesting time. By no means are we out of the woods here yet. No, by no means is the tornado past. We are very much in the eye of the storm. It's too eerily calm out there for this to be sustainable. Next chart that we'll get into here is going to be the sales chart. So, because that's what everybody's talking about. So we'll just toss that up and kind of debunk it. Now, yes, August 2020 sales are superiorly high compared to the August 2019. August 2019 were 713 sales. Now, that was a low sales month. I mean, for August. So that's what we kind of have to have a chuckle about. They go, wow, look how great 2020 is. But at the time, they're saying 2019 is not that bad. It's pretty good if you take this and this and this into consideration. So they always got a justification. So yes, August was above 1,100 sales. There was 1,108 sales in August, and July was the peak. That was 1,134 sales. Now, everyone wants to forget where we came from. We're going to remind you where we came from. Remember the anemic sales that occurred in April? 393 sales from April. So when you have an artificial low, you're going to have an artificial high. This is that basically breakout from those 2 months of paltry sales from 393 in April and 544 in May. What's interesting, if you take the 5-month average, which is your hot market from April to August, the 5-month average from 2020 is 810 sales. Now, that is better than the 2 previous years. Again, though, we said those 2 previous years weren't that hot. So 2019 5-month hot selling market average was 766. 2018 was 749. Now, here's where we get to actual hot markets. The hot period during 2017 was 1,190 average sales per month. In 2016, there was 1,441 sales per month on average. And in 2015, there was 1,669 sales on average per month. 2014 was 1,352 sales per month. But let's just take the last 5 years. So ending in 2015, the monthly sale average was 1,163. Now you tell me how 2020 looks good, or 2019 looks good, or 2018 looked good. And again, let's deal with 2020. Average of 810 sales each month in these 5 hot months. It's not a good market, folks, okay? Compared to 1163 of the average of the last 5 years, and the average of the last 5 years includes those 2 previous years of not hot seasons. Interesting, right? For us, it's interesting. So once you continue to go forward, average this out, increase need to sell, and really no need to purchase, no investment purchasing going on. It's just, if I got to buy, I got to live somewhere. And so those folks are purchasing. Again, mortgage rates are low, but now that will start to permeate. So I'm not really worried about them rising anytime soon. And there's a depreciating asset class that I can take advantage of. So yeah, our advice to potential purchasers, you got time. Time is on your side. Sellers, is probably not so much on your side unless you can withstand this next couple of years of a market downturn. Now, one thing, again, not all markets are created equal. Some markets inside of Greater Vancouver are overpriced. Some are kind of basically at their lows or very close to their lows in recent months. So there is potential for some investment depending on which area of Greater Vancouver that you're purchasing. And again, for that information, of course, become an Eitel Insights client and you'll never regret it. Let's move on to the next chart here. So we're going to move on to the inventory, and this will be our last chart of the day. Let's get into it. It's going to be kind of an interesting one. So the August total inventory at the end of the month was literally 4,800 active listings. Now that's horrible. I mean, just brutal. So July was, of course, worse at 4,631. Now. The inventory is 2,000 less than the summer months of 2018. Nobody wants to sell right now. These are the need-based sellers. And as you see properties, like that one example that we gave you, drop their price from 1.2 something million down to below $1 million to attract buyers. As you see more and more of those folks doing a similar type thing, the buyers will have more and more selection. As the buyers have more and more selection, they're going to go, wait, I see something, like I'm scared now. I'm starting to panic. And this is something that we started saying about 2 or 3 months ago. Just like we said, need-based selling would show up. This fear of overpaying for a depreciating asset will inevitably show up and rear its ugly head, likely in 2021, when there's more inventory and the inventory is need-based seller. It's them selling because they're getting out of Dodge, or the bank saying, hey, start selling or we'll sell it for you. Again, that mortgage and arrears article that we'll be releasing here shortly, it's really an eye-opener, and it's very cyclical. So history does repeat itself, and if you know that and you see what's coming down the tracks, you can get ahead of it and you can take advantage of certain scenarios. Again, why inventory is lower than 2018? The average sale price is down $200,000, right? That's the average. We've given you examples of properties that are really struggling to sell. Why would I put my property on the market unless I needed to get out? I just wouldn't. So now back to the chart. You did see that we broke out of that downtrend that basically was instigated during 2012. We are still rising. We are going up slower because nobody wants to sell. Eventually here, looks like in 2021, this yellow and the green divergent trend will finalize itself. We expect the inventory to go up, similar to maybe a 2008, 2009, something like that. Of course, you do see a shrinking asset class. We expect to see the inventory go at least 8,000 plus again. So that'll be an interesting time. Prices will be at the low, and that's when investment should be occurring. One other, it was debated, and now it seems to be less debated because now it's more interesting about the economic downturn. Is there going to be a second wave? So there's a lot of negativity here that I still see upcoming. You're ending the CERB payments. The mortgage deferral are coming to an end. Renters are starting to get evicted. So where's the positivity? There's low inventory, and prices should be running through the roof if there was demand. There isn't the demand. There's need-based selling or need-based purchasing because they got to live somewhere. But there's nobody that's really running down the block saying, I'm going to buy 2 or 3 of them at the same time. There's sellers that saying, I might need to unload 2 or 3, or at least unload 1 to save the other 2 or 3. And that's what will continue to permeate. Thanks for sticking with Eitel Insights. We hope you enjoyed the podcast. Again, if you did enjoy the podcast, please give us a thumbs up. Please feel free to share and subscribe to the Eitel Insights podcast. One other thing, we will be releasing the condo market update here in this month, so please stay tuned for that. And thanks for sticking with Eitel Insights. Talk to you soon. Take care.